This is not financial advice, educational content only. Headlines about the U.S. economy almost never mention Glacier Bancorp or Independent Bank Group. Financial media watches J.P. Morgan's net interest income, Citigroup's charge-offs, Goldman's trading revenue. Those institutions are useful for understanding how capital markets are functioning. They are not especially useful for understanding where credit stress is building in the real economy. Community banks, roughly 4,000 FDIC-insured institutions under $10 billion in assets, are something closer to a forward censor. They're lending to the small business that opened 18 months ago, the farm that needs a spring line of credit, the office building in a secondary market that's 60% occupied. When those borrowers get stressed, you hear about it in a community bank's provision expense before it shows up in a national survey. That's what we're here to look at. The term community bank gets used loosely. The FDIC's quarterly banking profile defines them primarily by asset size, institutions under $10 billion, and by business model, relationship lending rather than transactional originate and distribute. These aren't banks securitizing mortgages at scale and moving the risk off their books. They're holding the loans. That structural difference matters. When a large bank originates a commercial mortgage and sells it into a CMBS pool, its residual credit exposure is thin. A community bank that makes a $3 million commercial real estate loan to a local developer is holding that credit risk in full until the loan matures or pays off. The loan officer knows the borrower. The credit committee knows the submarket. The bank's equity capital is on the line. The consequence is that community bank loan books are geographically concentrated and sector concentrated in ways that large banks are not. Agriculture in the Midwest and Plains. Commercial real estate in secondary and tertiary markets. Small business loans, often SBA-backed in regional towns. Owner-occupied properties. This concentration is precisely what makes them informative. A national bank can absorb stress in one region with strength in another, and the aggregate numbers look fine. A community bank in eastern Kansas cannot. When it starts showing deterioration, the deterioration is real and it's local, and local is often where systemic moves begin. Here is the actual mechanism. Community banks file 10-QS with the SEC quarterly, just like large public companies. Even private community banks report detailed call report data to their primary federal regulator. The FDIC aggregates all of this in the quarterly banking profile, available free at FDIC.gov. 3 line items move first when credit conditions are deteriorating: provision for credit losses, nonperforming loan ratios, and net interest margin. Provision expense is management's forward-looking estimate of losses expected on the current loan book. When community banks across a region start increasing provisions simultaneously, that's not a lagging signal. It is management stating, in a public document filed under regulatory requirements, that they expect deterioration. That signal has historically appeared 6 to 12 months before the deterioration shows up in national delinquency surveys. Non-performing loans, those 90 days or more past due or on non-accrual status, are a present tense signal. Rising NPL ratios across community banks in the same sector mean the stress is current. Net interest margin compression is a different kind of signal. NIM is the spread between what the bank earns on its loan and investment portfolio and what it pays for deposits and funding. When community bank NIMs compress across the sector simultaneously, it frequently reflects deposit repricing running faster than loan repricing, which can indicate either a rate environment punishing fixed-rate loan books or competition for deposits that signals liquidity stress somewhere upstream in the system. The FDIC aggregates all 3 metrics in the QBP Community Bank cohort tables. That's your primary data source. That's my read. The sector breaks into at least 3 channels, where the early warning property is most consistent. First, agricultural credit. Roughly 800 FDIC-insured institutions categorize themselves as agricultural banks, concentrated in the Corn Belt, Northern Plains, and dairy states of the upper Midwest. Their loan quality tracks commodity cycles with a lag of roughly 1 to 2 crop seasons. When corn and soybean prices fell sharply in the mid-2010s, agricultural community banks began showing elevated NPA ratios in 2015 and 2016, well before the stress appeared in large bank agricultural portfolios or national charge-off data. The FDIC publishes a dedicated annual agricultural lending report. That's the document to pull if you want the baseline. Second, commercial real estate in non-gateway markets. Community banks have historically held CRE concentrations around 250 to 300% of total capital in the aggregate, per FDIC QBP data, well above the threshold where bank regulators apply heightened scrutiny. Stress in secondary markets, the suburban office park, the regional strip mall, tends to show up in community bank charge-offs before it's reflected in CMBS delinquency data or the earnings of a geographically diversified large bank. This has been a relevant dynamic through the post-2020 office market repricing. Third, small business credit quality, tracked directly by the Federal Reserve's Senior Loan Officer Opinion Survey, the SLOOS, published quarterly. The SLOOS specifically breaks out community bank responses on lending standards and loan demand for small businesses. Research by Cara Loan and Donald Morgan, a paper on the SLOOS and the business cycle that I'd encourage you to look up directly, found that the lending standards question in particular had meaningful predictive power for economic activity. When community bank loan officers simultaneously report tighter standards and falling demand, that combination has historically preceded recessions. This is the part that matters most if you're going to use this data, rather than just find it interesting. What community bank credit metrics actually mean? They are a granular, real-time read on the credit quality of the most rate-sensitive, least diversified borrowers in the U.S. economy. Small businesses, agricultural operations, regional CRE. These cohorts are also the most exposed to local shocks, a plant closure, a drought year, a commercial lease that doesn't get renewed. When stress concentrates in these borrower types, the historical pattern is that it spreads outward and upward rather than remaining contained. What it doesn't mean, community bank stress does not automatically translate to systemic financial risk. Individual institutions are small and largely unconnected. The transmission mechanism to something systemic requires either concentration among a few large interconnected players, which is not the community bank story, or a common shock hitting the entire sector simultaneously. A sharp rate increase repricing fixed-rate loan books is one such common shock. A commodity price collapse is another. A deterioration in local commercial real estate values across multiple regions simultaneously is a third. The distinction between idiosyncratic regional stress and a common factor shock is what separates interesting data from urgent signal. Stress concentrated in Midwestern agricultural banks in 2015 and 2016 was real credit deterioration. It was not a systemic event. Knowing the difference requires looking at both the magnitude, how large are the NPA ratios, and the breadth, how many institutions across how many distinct markets are showing it at once. Here's where I'll be explicit about what is interpretation versus what is data, so you can weight it accordingly. I'd encourage you to pull the FDIC quarterly banking profile directly, FDIC.gov, no subscription, rather than relying on my characterization of where the numbers stand, since the most recent edition will be more current than my knowledge. What I can say with confidence is that the NIM compression dynamic I described, deposit costs repricing faster than fixed-rate loan books in a rising rate cycle, was a documented sector-wide phenomenon through 2022 and 2023. Whether that pressure has fully resolved in the current data is something you'll want to verify against the most recent QBP tables. The signal I find more structurally interesting is the commercial real estate maturity schedule question. Community banks with CRE loans written at lower cap rates in 2018 through 2021 are now facing refinancing in a meaningfully higher rate environment. Loan extensions and modifications can delay the recognition of impairment. What shows up in the NPA ratio today may be understating the embedded stress in loans that haven't yet come to maturity. That's a distinction between current loss rates and forward-looking credit risk that the aggregate numbers don't make obvious. That's my read. The practical tool, in the FDIC-QBP, look at the community bank cohort table specifically, not the all-institution aggregate. Pull provision to average loans and NPA to total loans. Track them quarterly. The trend over 4 to 6 quarters tells you more than the level on any single date. The next thing to watch, if and when the Federal Reserve begins easing, pay attention to which community bank segments see NIM recovery first. Agricultural banks with short-duration variable-rate loans should reflect rate relief relatively quickly. Community banks carrying longer duration, fixed-rate CRE books may not. Track the divergence in the FDIC-QBP across those cohorts. It'll tell you whether rate relief is reaching the real economy or staying in traded markets. That's a concrete thing to look for, not a prediction. I'm Diane, back next briefing.